Welcome to the Apprentice Trading Library. This segment will explore the put-call ratio. The put-call ratio is a popular indicator used by investors to gauge the overall sentiment of a market or individual stock. It compares the trading volume of put options to the trading volume of call options. Here's a breakdown of the basics. Put options give the holder the right, but not the obligation, to sell an asset at a specific price by a certain date. They're typically used to profit from a price decline or hedge against existing holdings. Call options give the holder the right, but not the obligation, to buy an asset at a specific price by a certain date. They are typically used to profit from a price increase. Trading volume represents the number of options contracts, puts or calls, that are bought and sold during a specific period. Now let's look at calculating the ratio. Divide the total volume of traded puts by the total volume of traded calls. A ratio of greater than 1 indicates more bearish sentiment, meaning more investors are buying puts, anticipating a price decline. A ratio of less than 1 indicates more bullish sentiment, meaning more investors are buying calls, anticipating a price increase. A ratio of equal to 1 indicates neutral sentiment with roughly equal buying of puts and calls. We must also understand interpreting the ratio. Remember, the ratio provides a general sentiment gauge, not a guaranteed prediction of future price movements. Consider other factors like historical ratios, market trends, and fundamental analysis to form a comprehensive investment decision. The ratio can be more significant at extremes, very high or very low values, compared to being close to 1. Most traders use the put-call ratio as a factor only when the put-call ratio falls to 0.5, or below, or 1.5 or above. These extremes have worked well to signal a market reversal in the past. 0.5 on the put-call ratio means investors are heavily buying calls versus buying puts, and are then overly optimistic. 1.5 on the put-call ratio means investors are heavily buying puts versus buying calls, and are then overly fearful and pessimistic. However, there are limitations of the put-call ratio. It doesn't consider the strike price of the options traded, which can influence the interpretation. And it doesn't differentiate between options used for hedging and speculation. It only reflects short-term sentiment based on trading activity. Overall, the put-call ratio can be a valuable tool for understanding market sentiment, but it should be used in conjunction with other analysis and within the context of your overall investment strategy. Thank you for watching the Apprentice Trading Library. Please visit verifiedinvesting.com for more.